Good day everyone, my name is Raihana. I will begin with chapter 1, Introduction to Investment. Investment refers to committing money today with the expectation of earning future return. It is different from speculation, which involves higher risk and short-term profit expectation, and gambling, which is based purely on chance with no expected positive return. Moving to investment goal can be divided into two main categories: personal objective and financial objective. Personal objectives depend on the investor age, risk tolerance, and time horizon. Financial objectives focus on monetary returns such as capital appreciation, regular income, and wealth preservation. Next is the investment process. It begins with meeting investment prerequisites such as having sufficient fund and basic knowledge. This is followed by establishing clear investment goals and adopting an appropriate investment plan. Investors then evaluate available investment vehicle and select suitable investment. After that, a diversified portfolio is constructed to reduce risk. Finally, the portfolio is managed and reviewed continuously to ensure it meets the investor's objective. However, investors face several constraints such as limited capital, risk tolerance, liquidity needs, time horizon, and legal or tax restriction. These factors influence how investment decisions are made.
Hello everyone, my name is Sitra Clementi Zahari. My student ID is 203741093. I will cover risk and return and introduce the security market. In investment, return is the reward investor expect, while risk refers to uncertainty of actual return. Generally, higher returns are associated with higher risk. Investor must balance risk and return based on their risk tolerance. Securities market. The financial market is a place where buyer and seller trade financial assets. It helps business raise money, create liquidity, and support economic development. The financial market is divided into two main parts: the money market and the capital market. The money market deals with short-term funds. It includes marketable securities and foreign exchange. The money market acts as an intermediary by transferring surplus funds from savers to institutions for productive use. Securities market. Primary market. The primary market is where companies issue new securities to raise funds from their long-term goals, such as expansion or new project. One common method in the primary market is the initial public offering or IPO. An IPO is when a company offers its share to the public for the first time. By doing this, the company becomes a publicly traded company and is able to raise funds from investors. Primary market. An IPO has 4 stages: pre-submission to prepare document, regulatory approval for review, post-approval for marketing, and finally listing, where the company goes public. Companies raise funds in 2 ways. First, direct placement sells securities directly to investors for faster funding. Second, a right offering gives existing shareholders the chance to buy more shares, usually at a lower price.
Hi, I am Fatina Jaha binti Mashifun Nizam. My student ID is 2021680748. I will explain the secondary market and its related institution. The secondary market is where existing securities are bought and sold among investors. Trading is conducted through organized exchanges using electronic systems and ensure transparency and efficiency. In Malaysia, Bursa Malaysia provides a regulated platform for trading securities, while the Securities Commission oversees the market to protect investors and maintain fair practices. Stockbroking firms act as intermediaries between investors and the market. They execute trades, provide investment advice, and ensure transactions comply with regulations.
My name is Irina Sofia binti Muhammad Azlan. My student ID is 2023995951. I will be explaining about the two main types of investment alternative, which is real assets and financial assets. First, we have real assets. This real assets is tangible assets, meaning they physically exist and we can see and touch them. They have value because of their physical attributes. For example, land, factories, and buildings. Investors usually invest in real assets to maximize returns and diversify risk, especially over the long term. Real assets are also known to provide good returns, particularly when their value increases over time. Next is financial assets. For financial assets, this refers to investments, instruments, or securities such as bank deposits, stocks, and bonds. Financial assets have monetary value, but unlike real assets, they are not physical. Financial assets are not physical, they only become tangible when they are converted into cash. So overall, financial assets may seem intangible or non-physical, but they are still very important because they help generate income and wealth.
Hi, my name is Muhammad Akmal. Today I would like to conclude our presentations with advantage and disadvantage of real assets and financial assets, followed by investment instruments. First, real assets such as property and land can protect against inflation. They are tangible and usually provide long-term value, making them useful for wealth preservation. However, real assets have low liquidity, require high initial capital, also involve maintenance and management costs. On the other hand, financial assets offer high liquidity and require lower starting capital. Investors also have a wide variety of choices. However, their value fluctuates based on market conditions. They are exposed to economic risk and returns are not guaranteed. Moving on, investment instruments. Common stock represent ownership in a company but do not promise fixed returns. Preferred stocks offer fixed dividends and combine features of both stocks and bonds. Unit trusts are collective investment managed by professionals and provide diversification. Derivatives depends on underlying assets prices. Real estate involve property investment with high return but high upfront costs. Bonds are debt instruments where borrowed money is repaid with interest, while gold is popular as long-term hedge against inflation. That's all from me. Thank you.